Let's bring in former Fed Vice Chairman and CNBC contributor Roger Ferguson. Roger, great to have you with us. I'm sure you've been listening into this conversation about the deficit and the impact on long-term on interest rates. I understand this is the fiscal side of things. The Fed is concerned with monetary policy, but the two meet at some point. There's an impact on the economy, which the Fed has to grapple with. How do you think about that longer-term problem?
Look, I think the reality is that the Fed is going to stay and should stay focused on its mission. It can control inflation by, driving interest rates. Unfortunately, I think they perhaps may have to move a little bit higher. And then that leaves the other side of the house, the fiscal side, to manage through it. I think it would be very unwise for the Fed to say, well, we must be done now because we're imposing too much cost, the interest burden on the fiscal side of the house. There are some other ways to fix that problem that you've been talking about, obviously income taxes, increasing revenue, broadening the base, managing spending more wisely. That all belongs to the elected officials. They've asked the Fed to look at interest rates and inflation, and that's what they should be doing.
There's a notion in the markets, Roger, that, the Fed is looking at financial conditions and sort of managing that. There's a needle to be threaded. And the reality is that, the Goldman Sachs Financial Conditions Index last week saw its biggest weekly drop since 1990. So conditions are getting looser. Should investors be concerned? I mean, we did see the S&P 500 go up 6%, more than 6%, in the time frame in which the 10-year yield gave up 50 basis points.
Look, I think the Fed is taking notice of it. President Lori Logan talked about the concept of retracement, I think her phrase was, and saying she had to watch closely. We heard at the last press release from Chairman Powell that, the tightening of fiscal conditions, mainly with the 10-year rate, could be doing some of the Fed's work. So, yes, this retracement, this loosening of financial conditions, I think will certainly be a conversation at the December meeting. And I think it's one of the reasons why the December meeting, contrary to what the markets believe, is still certainly at least a live meeting. Not definite, but I would say the probabilities of a possible move there are maybe higher than the market currently expects, in part for the reasons you laid out.
It's a 90%, right? What's being priced in is 90% no move. So I guess it's 10% live, Roger, in that sort of scope. But you think that it's actually greater than that the markets are getting this wrong at this point, given the easing in financial conditions that we've seen?
I think so. I'm not saying that they're definitely going to go, but we've heard a number of them talk about having an open mind. It's too early to prejudge. President Bostic from Richmond was out with that kind of phraseology. Tom Barkin, President Bostic, from Atlanta, Barkin from Richmond, Kashkari from Minneapolis. All of them. There's a general chorus that says, December, not yet prejudged. There are 2 inflation reports to come in. And so I think there's a fair amount of data for a data-dependent Fed to chew on between now and the December meeting.